A very good evening to all the participants and welcome to our annual feature since more than a couple of decades, wherein we have been having a client interaction meeting. And prior to the pandemic days, we used to have physical meetings wherein it was an opportunity to interact with each of you on a face-to-face basis. While things have improved, they've still not so improved that we could really think of doing a physical event. And therefore, this year also post the budget, we decided that we'll have a outreach program which is virtual rather than physical. Let's hope and pray that the next year we can have a physical meeting where we can see each of you in person. With those preliminary remarks, let me start with the discussions for the evening. And as you are aware that over the last few years, being an indirect tax firm, we would be restricting our discussions to the GST proposals of the Finance Bill 2022. And when we looked at the finance bill and the announcements made by the Honorable Finance Minister in her budget speech, one important aspect which came out very clearly was the success of the GST law. And that success of the GST law, acknowledged by the Honorable Finance Minister, came from the fact that the collections for January 2022 were the record highest over the past 5 years. Having said that, we have such a huge collection of revenue from GST itself, resulting into a substantial component. In fact, today when we look at the tax revenues of the union, typically the tax revenues get divided equally between personal income tax, corporate taxation, corporate income tax, GST, and then the last component would be the union excise duties on petroleum and the customs duty. So in that sense, GST has found its rightful place over the 5 years. It has definitely eased a lot of complications for the taxpayers. And we have seen the earlier days of VAT and service tax, wherein we had so much of reliance on documentation and a lot of to and fro and disuniformity. GST definitely has brought in a substantial level of uniformity, and it has reduced the effective tax burden as well as reduced cascading. Having said that, we also need to bear in mind, and because GST will be closing 5 years in July this year, it is also time to step back and think that over the 5 years, what were the promises made by the law and to what extent have they been fulfilled? And I think one of the important promises which was made, or which was the USP, and in each of the client interactions we used to discuss this, was this concept of seamless input tax credit. And this budget, I think we will have to analyze from the perspective of whether that dream of a utopian GST, where of an ideal GST, where the credits flow seamlessly, whether the budget is a step towards achieving a bit closer objective of a seamless credit, or are we conflicting or deviating from that objective? I leave it for each of you to decide towards the end of the session the direction in which we are moving. But without much ado, let me straight away take you through the key GST amendments. These GST amendments have been explained in our special budget flash, which was circulated on the 1st of February itself, immediately post the announcement of the budget. And as you can see from that flash, the key highlights of the GST related amendments can be divided into 4 or 5 broad baskets. The first basket being some further restrictions in availment and utilization of input tax credit, because somewhere, despite a substantial buoyancy in the revenue, there is a thought process, maybe right, maybe wrong, it is something which is very, very subjective, but there is some thought process at the higher echelons of the government that there is a substantial misuse of the input tax credit benefit by various subsections of the industry or trade. Some scrupulous traders might be misusing the system, and that's the fear or the apprehension. And therefore, every year we see some amendments being brought in the law to try and tighten the screws in this regard. And there are some further restrictions in this budget as well. And we will talk about each of them as we move into the detailed discussion. And this has always been a grouse that I am a buyer or a recipient claiming an input tax credit. You want to penalize me because of some default or fraud done by the supplier. And that is not a fair mechanism. And in fact, courts have also come at various points of time to the rescue of the recipients, saying that the recipient cannot be denied a rightful input tax credit due to some default of the supplier. Of course, there are conflicting decisions on this part, And therefore, when they make the amendments, they also want to make sure as a government that the suppliers also make sure that their compliances are done in a better manner and a more correct manner. So there are some amendments to ensure a better compliance by the suppliers so that the restrictions in availment and utilization don't happen. A better sense prevailed. From day one, we have been talking about the 5-step two-way communication process of filing a return, wherein there is a GSTR1, then 2A, then 2A followed by GSTR2, then 1A, and thereafter ultimately resulting in a GSTR3. And we all know a lot of water has flown, that the entire system never worked. A lot of course corrections kept on happening in the interim. There was something known as a 3B, which was a return, which was introduced. 2 and 3 were suspended, and necessarily, therefore, GSTR 1A also never happened. In the interim, we also talked about a RET1, RET2 process. We had a detailed session, but that also the government found that it is not workable. So end of the day, as we know today, we have implemented a mechanism wherein we have GSTR1, which is a return of outward supplies. Based on the return of outward supplies, there is a document called GSTR2B, which the government gives you by the 12th or the 13th of the month. And once you get that document, you are expected to do a matching of the input tax credits. And only on the basis of matched input tax, claim the credits in your return, which is known as the GSTR 3B, and you pay the taxes by the 20th. Now, while all of this was done through the rules and procedural aspects, the law was never amended. And that is where this budget tries to bring in a course correction. It brings in a finality to this entire process, and it tries to amend the law to say that there will never be GSTR 2 or 3, and this is what is the certainty on the entire law. So in a way, it's a course correction. Yes, we are doing away with the two-way communication and bringing in a one-way communication. It has its own sets of challenges, but well, that's how it has been implemented over the 5 years. And in a way, it brings in a certainty to say that this is how it will be implemented moving forward also. Some of these might be onerous or compliance related provisions, but there are some beneficial provisions sprinkled to balance the entire process. And let's quickly look at some of them. One is, of course, there is a time limit for certain actions like input tax credit, credit notes, etc. That time limit is sought to be extended slightly. And now instead of the due date of September, filing the September return, it is now a hard-coded date of 30th of November. If you are having 5 registrations in the same PAN number, multiple GSTNs of branches, and you have cash balance in one account, you can now transfer the electronic cash balance to another GSTN of the same PAN. So that is a permission which has been granted. Again, this was a decision made by a GST council meeting, and the amendment is ratifying or bringing in that impact of that decision which was taken in the GST council meeting. Similarly, we have scenarios where a person might have claimed a credit. It's lying in his credit ledger. He has still not used it for paying any taxes. And later on, he is required to reverse it because of various allegations of wrong availment. In this case, the question was whether I should be required to pay interest, especially because I really didn't gain anything. And there was no loss to the exchequer in terms of the cash outflow involved. And that's where, again, GST Council in one of its meetings took a decision that we will charge interest only if there is a wrong availment as well as a wrong utilization. If you are wrongly availed but still not utilize the credit, then we will not charge you interest. So we have a provision called section 50 subsection 3, which is amended to bring in this concept of interest only on wrong availment and utilization. Even there was a controversy about the interest rate of interest applicable. There was a section of the department officers who were interpreting that the interest rate should be 24 instead of 18. That also has been clarified, and the matter has been put to rest. Right from a retrospective effect from the inception of the law, we are told that the interest rate will be 18%, and there's a notification very specifically made out for it. There's a small clarification relating to the relevant date when you are filing a refund application, being an SEZ unit or a developer, or making supplies to SEZ units or developers. And some exemptions were granted in 2019. And there was an open period for those exemptions for 17 to 19, typically for a fish meal or for a reverse charge mechanism for licenses obtained for alcoholic liquor license. for those types of exemptions which have been granted from 19, a retrospective exemption has been given from 17 to 19. Those are very specific industry types of provisions. So a few beneficial provisions, but if you can look at this slide and our flash note, you will find that a major emphasis is on input tax credit. So while the budget does talk about a few provisions relating to input tax credit, and some of them are notable and landmark provisions, what we felt was over a period of time, the entire concept of input tax credit, which was promised as a seamless input tax credit, resulting in no cascading and resulting in efficiency in businesses, we have seen bits and pieces, and at each and every time whenever there was an amendment, we have outreached to you and have had advisory and a client outreach program where we've explained all of these. They are available on YouTube. But I thought that this could perhaps be an opportunity to really take stock, and right from 2017 when the law was introduced till date today, how things have progressed, and effectively as of today, irrespective of whether the amendment was brought in by the budget or was there beforehand, what are the provisions, or what if I want to claim input tax credit, what are the steps which I should follow? And when we tried doing that, we were surprised. Of course, in bits and pieces, we were aware that input tax credit is becoming complicated and it's no longer as seamless as we would have loved it to be. But when we started jotting down points, we realized that it's really a handful. And we could ultimately summarize that there is an 18-step process before a person can claim input tax credit. So any credit which an organization claims and uses, it will have to pass through these 18 steps. And mind you, these 18 steps will apply for each transaction which you are on which you wish to claim input tax credit. It could be as a high value item as a raw material purchased, or a huge capex which might be involved when you are expanding your factory, or it could be as simplistic as air travel of your marketing executive. Each of those input tax credits, wherever you wish to claim input tax credit, they will have to follow this 18-step process. And therefore, it's important to understand what each of these steps are. Some of these steps are simplistic and obvious also, whereas some of these steps are really the pain in the neck. And we'll go through them one by one to understand each of those steps. So what are those 18 steps? And as we all know, the first step, the genesis of any input tax credit is they give you credits on goods or services which are used in the course or furtherance of business. And therefore, the first and the logical starting point of any input tax credit would be a scenario where you are buying or procuring some goods or services. And in fact, this is one of the basic conditions under section 16(2) subsection B, that for any claim of input tax credit, you should have received the goods or services. Looks a very simple thing, and most of the organizations, we would say that yes, we have an ERP, there's a GRN which would record the inward of goods or services. In many cases, even services are inwarded through the GRN process. In many cases, there would be a service which you can show a consumption or a receipt. Goods, it will become a part of your inventory. And based on that documentation, one can say that, look, I have received the goods or services. And it's a non-starter or not a very complicated situation to explain. But over a period of last couple of years, what we have seen is there have been some misuses of this system of input tax credit. And somewhere the government feels, or the officers feel, that there are many examples where there are people who would raise invoices but not supply the goods or services, which is commonly known as fake invoicing. Couple of years back, we had a detailed set of provisions brought in the GST law to tackle this problem of fake invoicing. Similar provisions were also brought in the income tax law. But at times, the transaction may be genuine, but there is an allegation of a fake invoice. And when we look at the way fake invoicing is alleged, it's typically based on data analytics. Somewhere, the officers and the government have started feeling confident, or to some extent, I would say overconfident, on the data analytics thrown by the GSTN portal and the NIC portal, which is a huge knowledge repository. And based on that, we are seeing an abstract set of transactions which are just stated to be fake, because there are the entire logic is based on certain parameters, and those parameters may not apply in all cases. Despite that, the department might come back and say that, look, I am seeing a list. In that list, I am suspecting that your purchases are fake. And therefore, we have lots of these examples wherein either the state tax evasion teams or the DGGI from the central tax evasion teams allege that some purchases which you have done maybe today, maybe 1 year or 2 years ago, are perhaps bogus purchases or fake invoices. And that's where I think it will be important for you to ensure that you have a proper goods receipt note, a delivery challan. While the law may not require an e-way bill as a mandatory condition, many a times we are seeing department officers inferring an absence of an e-way bill or an availability of an e-way bill to be one of the key parameters for fake invoice. And therefore, and as we know, many of the organizations, they don't want to go into the hassles of doing e-way bills themselves. And the provisions of e-way bill also mention that it's the person causing a movement who is going to generate an e-way bill. So many organizations request for landed delivery of the raw materials or goods at their warehouse, and they pass on this obligation of raising the e-way bill and the corresponding day-to-day compliances either on the vendor or on the transporter. Now, in all those cases, it will also be a little bit important now, considering the way the law is evolving, that an organization keeps a track that for whether various raw materials which are received or especially large value goods which are received, whether appropriate e-way bill compliance is done either by the vendor or by the transporter. Today, data analytics is throwing up so much of possibilities that the department is not only stopping at the GRN or the e-way bill. At times, they are also going through the FASTag records to make sure that the e-way bill was actually supported by a genuine movement of goods. Because in a FASTag, there's a vehicle number. In an e-way bill, there's a vehicle number. And when you match those two vehicle numbers, you can really find out whether somebody really just did an e-way bill on the portal, or whether that e-way bill was actually later on honored through a movement of goods from one city to another city. Again, when we look at FASTag, one more level of detailing would be that the department may look at a FASTag and the vehicle number and compare it with the M-Parivahan website, where there is a status of the vehicle. So many a times you might have generated an e-way bill and that might not be a commercial vehicle. It might be just a motor car or a passenger vehicle. And in that case, again, the presumption of fake invoicing starts increasing. So all these aspects, taxpayers will now have to be a little bit more careful to ensure that they can thwart these queries about fake invoicing or successfully defend those queries about fake invoicing. All of this applies to goods, but then the larger question is, today services constitute a major component of your input cost. And when you are claiming credits of services charged by various contractors, consultants, manpower suppliers, the question which comes is, how are you going to establish the receipt of such services? And again, there cannot be one cut answer for all these questions. We are aware of recently major payment aggregator, how the fraud happened there, and the manpower supplier was non-existent, or a scenario where the manpower supplier never supplied the manpower, was paid huge amounts as consultancy fees. Now, these types of situations, I think one will have to walk the bridge, and one will have to make sure that there is enough trail documentation to suggest that there is a provision of a service or a receipt of a service, and that service is received and consumed by the organization. I'm sure if we think a little bit intellectually, we'll be able to find out answers from our internal control mechanisms, from our internal audit processes, and definitely we'll be able to substantiate some or the other basis to say that we have actually received the service. So that is one aspect relating to fake invoicing. Another aspect which comes out is, while the credit is available at the time of procurement and the receipt of tax invoice, there could be a scenario that the product, though intended to be used for business, is ultimately not used for business, or is written off, given free, or given off as a sample, or destroyed by fire, or something like that. In that case, we are aware that section 17(5) subclause H, which requires the credit to be reversed. The challenge which we are seeing is that, are we going to read 17(5)H literally to say that the credit is required to be reversed only if there is a subsequent write-off or free supplies as such, or will one even go to an underlying transaction? And let me take an example. I am a pharma company I am required to give free samples to various doctors. Now, when I give those free samples, those samples have been manufactured by me out of various raw materials bought by me and on which I have claimed the credit. Whether I am required to reverse the credit of the raw materials embedded within the final product which is supplied free. Our view is that there is no such requirement, and there is a concept of removal as such, which was a time-tested concept under Senvet credit rules. And the way section 17.5H is worded, it will apply only to a situation of an incident where the product on which the credit is claimed is the very product which was lost in fire, destroyed, or supplied free of cost as a free sample. So it has a very limited applicability to removals or supplies as such, is what we would believe as far as 17.5H is concerned. So that is step one. You have to make sure that you have procured the goods or services, and naturally you have used it for the furtherance of business. That takes me to a step two. It's not merely the procurement of goods or services. It's also important that you obtain a valid tax invoice. Again, when we are talking about valid tax invoice, it's a condition which has been mentioned in section 16.2 subclause A. There's a rule 36 which defines the fields which are mandatory fields for claiming the credit based on a tax invoice. It also talks about situations where documents other than a tax invoice will be treated as a valid document for the purposes of claiming the credit. Now, while there's a long laundry list of items which have to be mentioned in a tax invoice, the rule 36 subrule 2 also lays down some minimum mandatory fields which will be required in the tax invoice if you have to claim the credit. So therefore, as an account payable process, it is important to make sure that our invoice contains the minimum mandatory fields which are listed down under rule 36.2. In one of our earlier sessions, we have dealt with in detail each of these provisions, and therefore I'm not going too much into detail, but this is just a sort of a quick refresher of that. If you have any doubts on this, you can put them in the chat box, time permitting. We will deal with that. Otherwise, you can also look at our YouTube channel, wherein all our past videos have been uploaded, and you should be able to find your answers from there as well. When we are on rule 36.2 and the mandatory fields, one of the mandatory fields of a valid tax invoice is a place of supply. And that's where a controversy which is brewing is a scenario where you are situated in Maharashtra and the vendor issues you a tax invoice which comes in your GST number of Maharashtra, 2A of Maharashtra, but it has a place of supply which is tagged to some another state. And there has been a thought process at the department level that if your place of supply and the state where you are registered are not matching, then the credit is not available to you. That is a thought process. We tried desperately, and since the past 5 years, we have been trying it, and we are struggling to find a provision in the act or in the rules which says that you can't claim the credit if the place of supply is different than the state where you are registered. I'm aware there is one adverse advance ruling, but as we all know, advance rulings are not binding on the trade. They are binding only on that specific SSC, and they do not represent the legal interpretation of the law. That's the interpretation of one particular officer. So this is one challenge which is there. Depending on the risk appetite of an organization may choose to ignore this aspect of POS mismatch and claim the credit, or it may choose not to claim the credit depending on its risk appetite and the materiality of the risk. Another aspect which is very important, and in recent times we did a few sessions around this, was the mandatory e-invoicing which has been introduced for large taxpayers. As you are aware, if you are a supplier and your aggregate turnover exceeds 50 crores, in that scenario, you are required to mandatorily issue e-invoice which contains an IRN and a dynamic QR code. Now, when we are talking about that provisions, and we have detailed sessions when we talked about that, from a recipient's perspective, this rule 48.5 becomes very important, which says that if e-invoicing is applicable to a supplier or a vendor, then if he issues a non-IRN invoice, meaning a traditional invoice the way it was expected, it was done a couple of years back, in that scenario, that invoice will not be treated as a tax invoice. Therefore, even if your turnover is less than 50 crores, or even if your turnover is more than 50 crores, it's important that you check with your vendors whether they are eligible or liable for e-invoicing under Rule 48. If they are, you should insist on an IRN generated tax invoice and electronic invoice. And if not, then you should not accept those types of transactions. Now, how do I know whether it's applicable to him or not? I understand initially there was a website where you were able to find out whether it has been enabled or not. If you are not able to find that, you maybe as a part of an accounts payable process, we can obtain a vendor statement or a communication or a declaration saying that whether they are eligible for e-invoicing or not eligible, and accordingly you may need to action out the processing of the tax invoices submitted by the vendors. Rule 36.1 talks about a tax invoice. It says that for import of goods, it's going to be the bill of entry which you have cleared for home consumption. That will be the duty paying document on the basis of which you will claim the credit. For RCM transactions where you are paying the tax yourself, please note the challan is not the document. Just like for customs, the challan is not the document. It's the bill of entry which is the document. Same way for RCM, the challan is not the document. It is a self-invoice which is prescribed to be issued under section 31(3)(f), which becomes the document for the purposes of claiming input tax credit for RCM cases. For banks, financial institutions, and for insurance companies, for airlines and GTA, there are special provisions under Rule 54 which permit a monthly statement or a ticket in the case of an airline to be treated as a valid tax invoice. And certain fields, there have been relaxation for those types of SSCs. So those credits can be claimed on the basis of those types of documents issued by those relevant entities. So that is as far as the obtaining of a valid tax invoice is concerned. So friends, that explains to us the first two steps of the 18-step process. We now go to the third step, which is the entry in the books of accounts. And as we know, businesses are mandated to maintain true and fair account of their financial affairs, and for that we have elaborate books of accounts which are maintained by organizations, mostly in systems, maybe an ERP or a simplistic accounting software like a Tally. And this step talks about the impact of books of accounts on input tax credit. And as we know, section 16(3) clearly mandates that there cannot be simultaneous claim of depreciation and ITC in case of capital assets. And this similar provision was there under the Servant Credit rules also. And it's logical also because you can't have double benefit. Input tax credit is also a benefit, and same way depreciation is also a benefit. Same way when you're looking at revenue items, ideally the expense out of an item and of a component of an amount and claim of input tax credit is accounting, there's a conflict. There is no specific provision which says that you cannot account for revenue on a gross or an inclusive basis, but logically the accounting standards would require you to treat the input tax credit as an asset and not as a part of the expenditure itself. Very loosely put, if let's say there is a telephone bill of 100 rupees on which there's an 18 rupees GST, an ideal accounting treatment would be to treat the telephone expense as 100, GST credit receivable as 18, and 118 hitting your bank account. And that is what we say is an exclusive method of accounting. This will also be in alignment with the requirement under the GST law to maintain a separate input tax credit ledger. Section 35(1)(d) talks about it, and that is also an important requirement. A larger question which comes is whether this ITC ledger, which is as per my books of accounts, should reconcile and match rupee to rupee with my GST or 3B electronic credit ledger. I would believe so. If there is a difference, that differences should be explainable. If they are not explainable, necessarily at some point of time, there can be a challenge either in terms of your accounting treatment or in terms of your GST treatment. And therefore, it's important that as time progresses, there should be an appropriate reconciliation between these two sets of documents. When we did GST audit, and earlier there was a mandatory GST audit to be done by an external consultant. Now, of course, it is a self-certification. Despite that, what we have seen is our experiences have been varied. And in many cases, we have seen that while regular filing of returns, there has been not much of an emphasis laid on the accounting part of those transactions. And that's where I think it's important to have that type of a reconciliation ready so as to avoid unwarranted questions and unwarranted liabilities at a future point of time. Also, at any point of time, we need to also understand that in most of the ERPs, today there is a time stamping involved. And therefore, at times, when we talk about a scenario that I want to claim a backdated credit, and there are timelines of claim of ITC, which all of us are aware of, and sometimes we want to do a sort of a teaming and lading and say that a credit was actually claimed much earlier than what it was recorded in the books of accounts. Maybe entry in the books of accounts and the time stamping can be an indicator of a compliance or a non-compliance, and therefore one has to tread this route a little bit cautiously and cannot look at it casually, is what I would believe. So that is the third aspect which becomes important. After you procure the goods or services and obtain a valid tax invoice, you enter that transaction in your books of accounts. I'm not saying you have paid it, but you still entered the transaction in the books of accounts. Fourth aspect is the test which you have to lay down and check whether you have used those goods or services in the course or furtherance of business. Make no mistake, unlike the Senvet credit rules, there is no direct nexus with a taxable output which is required. The nexus is with a business, and the input supply should be used in the course or furtherance of business. And that's where the interpretation of business becomes very important. Business by itself is defined under section 2, subsection 17 very widely. And therefore, one might believe that many of the transactions would constitute business, and generally anything which becomes a part of your P&L account or a part of your books of accounts should be eligible for input tax credit in view of the extended meaning of the term business. There are some specific issues which come up when we talk about CSR related expenditure. And as we are aware that the law relating to CSR also has been progressing over a period of time, and there are mandatory requirements of CSR which have been laid down. Now, either that CSR can be satisfied through making donations to third-party trusts or funds like the Prime Minister's National Relief Fund, or you could spend the money directly on charity. Now, when you are spending directly on charity by procuring various goods or services, the question which arises is whether the input tax, the taxes charged by the various vendors on such goods or services which you have procured for directly meeting the CSR obligation, whether that will be eligible as an input tax credit. We have discussed this in one of the earlier sessions. There are conflicting advance rulings. Our view is that CSR is not to be treated as in the course or furtherance of business. In fact, the Companies Act clearly has a regulation to this interpretation. Also, the Income Tax Act also is very clear on this, that the CSR expenditure is not allowed as a deduction under section 37. And therefore, on a conservative basis, while there are two views possible, we would believe that the input tax credit on CSR related expenditure should not be claimed by the taxpayer. That takes me to the second area wherein we are going to talk about various employee related expenditures or general expenditures. And this can include a wide section of expenditures which companies incur to make sure that their employees are retained for a longer period of time. Some of them are specifically debarred. Something like a mediclaim is a group mediclaim taken by the organization, is specifically debarred under section 17.5. We'll be talking about it in a few minutes. But assuming for the moment that it is not specifically listed in any of those specific disallowances mentioned under section 17.5, the question is whether the department can disallow an employee related expenditure only on the grounds that it is not used in the course or furtherance of business. I would believe no, the department would not have a strong ground on that account, because any expenditure which is incurred towards an employee is definitely in the course or furtherance of business. In the Senvet credit regime, we had matters going all the way to the courts, and Ultratech Cement, Bombay High Court is very clear on this aspect to say that the activities relating to business is a very wide term, and if it is a genuine business expenditure deductible under section 37(1) of the Income Tax Act, it should be treated as an input credit item for the purposes of GST also. Again, I am caveating this to say that if there is a specific provision under section 17.5 which says that this expenditure will not be allowed, maybe a club expenditure or a mediclaim expenditure, then naturally you will not claim it, because there's another provision which says that you cannot claim it. As far as investment related expenditures are concerned, we need to bear in mind that investments are securities. Securities are treated as exempted supplies, and there is one more provision which says that any services which are used for exempted supplies are not eligible for credit. Therefore, here even we'll have to be a little bit cautious about claiming the credit, especially in today's atmosphere of high stock volatility, and even many companies might have cash flow they might invest in units or treasury or into various stocks. And in those types of scenarios, if you are investing in those assets and there are some demat charges or a brokerage charge relating to those expenses, to those investments, the GST charged by the broker or the bank would not be eligible to you as a credit. Now, naturally, someone will say that there could be cases where there can be a mixed activity, especially in case of proprietary concerns, where he might use a telephone both for personal purpose as well as a company purpose. In case of such mixed use, we are told that there will be a 5% disallowance based on Rule 42(1) Subrule G. Now, please note this will apply only when the expenditure is used as a common expenditure for business purposes as well as non-business purposes. Now, non-business purposes for proprietary, one can easily identify through an example which I gave. But for corporates, typically there's a school of thought to say that everything that a corporate does is in the course or furtherance of business. And therefore, in those cases, this rule may not apply and the credits can be claimed in general also. So that is as far as point number 4 is concerned, step 4, where you have to establish the usage of the goods or services in the course or furtherance of business. And that takes us to step 5 to check whether the credit which you wish to claim is blocked or not. And as we are aware, and we talked about various situations here in the past, Section 17, subsection 5 deals with blocked input tax credit, and the 7 or 8 sub-clauses deal with various items which are not eligible for input tax credit. Just as a very quick rebrush, subclause A deals with motor vehicles which are used for passenger transportation. Of course, if the capacity of the motor vehicle is about 12, excluding the driver, typically mini buses and buses get covered there, then the credit is allowed. Otherwise, normal motor cars or a 8-seater vehicle, the credits are not allowed. For purchase of those motor vehicles, credits are not allowed for services related to those motor vehicles also. For example, if there's a rent-a-cab, the credit is not allowed. If there's an insurance relating to motor vehicles, even that credit is not allowed. All of that is, of course, the first basket of disallowances. Thereafter, there are specific supplies like food and beverages, mediclaim, club membership, life insurance, etc., which have been listed in subclause B, wherein we are told that credit of these items are not allowed unless they are mandated by a law for the time being in force. So for the time being, we can skip that mandating aspect, and when for the time being, we can assume that the credits of these are not allowed. C and D deal with works contract services or goods and services which are used for construction of an immovable property. Here there's a saving grace that if the construction of an immovable property is related to plant and machinery, then the credit will be allowed. Otherwise, the credit will not be allowed. There is also an interpretation of construction which says construction would be something which sits in your balance sheet. If there are repairs, renovation undertaken which go in your P&L account, then those items will not be hit by the subclauses C and D. It's only the balance sheet items which are for the construction of an immovable property which will be hit by this provision. That too for transactions other than plant and machinery. E deals with taxes paid under composition. As it is, the composition dealer does not disclose the tax separately in the invoice. Clause F deals with a non-resident taxpayer for whom all input tax credit is denied except the very raw materials which are being sold by him. Subclause G deals with disallowance for goods or services used for personal consumption. Again, nothing of much significance to talk about here. Subclause H, we talked about it earlier, goods lost, stolen, free samples, return off, etc. As explained earlier, we believe that this entry applies only for goods lost as such and not the input goods which are embedded in the goods which are lost. Subclause I disallows any input tax credit if the tax is paid consequent to an allegation of a fraud or an issuance of a show cause under section 74. So these are the disallowances or blocked credits. So you have to check as step 5 whether my credits are blocked or not. That takes me to step 6, which is you have to then check whether you are providing any exempted supplies. And if you are providing an exempted supplies, then maybe section 17(2) triggers in your case, and you have to classify all your inputs into inputs used for taxable, exempted, or common supplies. We are aware, we have talked about it in the past, we are aware that the meaning of exempted supplies not only includes nil rated goods, but and services exempted through notification, but also includes transactions like activities in securities, activities of land and building, and transactions where the supply output RCM is applicable. At the same time, it excludes interest, ocean freight, schedule 3 items, like for example, if you have a high seas sale, that's excluded from the definition of exempted supply, and all zero rated supplies, maybe exports of goods or services, maybe taxable goods, maybe exempted goods. But if you are an exporter, then for the exporter, the exports are excluded from the meaning of exempted supply. We are aware of this, and we have had detailed presentations earlier on this aspect, wherein each of these aspects has been explained with a detailed analysis. Having understood what is an exempted supply, whatever credits you intend to claim have to be classified as either common credits, which in typical language we say is a C2 basket, or an exempted services used for exempted supply, which we say is a T2 basket, and services exclusively used for taxable supplies, which we say is a T4 basket. There is a provisional and a final expense of ratio depending on the ratio of taxable and exempted supply, which has to be done as per Rule 42. Now that Rule 42 expense of ratio has to be done month on month. And at the end of the year, you again recalculate that entire thing and do a final expense of ratio. Now, naturally, when you do a final expense of ratio, you will find that it is either higher or lower. If it is lower, you reclaim that credit which you have excess reversed from month to month. If you have claimed lower, then naturally you will have to pay again at the time of the calculation of the final expense of ratio. And that's where there is an interest implication right from the 1st of April till the date of reversal on account of final expense of ratio. Now, in the first slide, we did talk about a scenario where we said that interest is payable only if the credit is availed and utilized. Make no mistake, that is a general provision, whereas Rule 42 is a specific provision. And here, the interest on reversal on account of final expense of ratio is payable even if you have a accumulated balance of input tax credit. So here, the theory of not being out of pocket is not applicable, and you will have to pay this interest irrespective of whether you have substantial input tax credit lying idle in your books of accounts. So that is one caveat which we need to bear in mind. So friends, we have completed 6 out of the 18 steps. We now go to the 7th step, which is a recent one. The first 6 steps to a large extent was a revision of what we have done in the past, and we've talked about it and you understood it over the last 4-5 years. But from 7th, things get a little bit complicated, and now we have an onerous condition which has been cast from 1st of January 2022, which is that the credit should be matched with the GSTR2B. And we had a detailed session just a month ago, and we explained how this entire process has to be done. We are aware of this section 16(2)AA, which was proposed by the last finance bill and was made effective from 1st of January 2022, which means that the tolerance limit for unmatched credit under Rule 36(4) was phased out. Earlier, as we know, up to 2019, rather October 2019, there was no requirement of matching, and there was no upper limit of unmatched credit. Then a 20% limit was brought in, which then got reduced to 10, which then got reduced to 5. And then from 1st of January 2022, we are told that you have to have 100% matching, no unmatched credit can be claimed. And when we say no unmatched credit can be claimed, a common question which came up was, can I ignore my books and claim the credit as appearing in my GSTR2B? And the answer is clearly no, because of the earlier steps which we talked about. The steps 2 and 3 clearly talk about receipt of a tax invoice, recording of the entry in the books of accounts, and therefore your anchor point will always have to be a books of accounts, resulting in an elaborate process of transaction level matching. We talked about it and we demonstrated it through some examples in the last session, where you will download a GSTR2B from the government portal. You will take the ITC dump or the GL dump from your accounting system or the ERP, and then use a VLOOKUP method in Excel or use some ASP GSP to identify the matching between these two transactions, and you might end up with an exact match. And in case of minor errors, you might make some forced matches. There could be examples of mismatches also, and organizations, I'm sure, have by now developed mechanisms to control this mismatch and monitor them and chase the vendors for corrective actions in this regard. All of this, as we are aware, applies for forward charge invoices. It does not apply to imports, RCM, or ISD transactions. When we say forward charge, it's applicable across all document types, meaning invoices, debit notes, as well as credit notes. And in credit notes, because of the negative reporting, it becomes a little bit difficult to really, one more additional processing step comes into the entire basket in terms of identification and conversion of the negative amounts into the absolute numbers. And recently, we found one very, I would say, painful allegation in one of our clients' cases where the vendor had uploaded an invoice wrongly in the client's account, and therefore he reversed the invoice through a credit note. Rather than cancelling the invoice, it was reversed to the credit note. And both this invoice as well as the credit note appeared in the 2A. Naturally, because the client was not, they had not received any goods or services and it was not his transaction, he neither recorded the invoice nor the credit note in his books of accounts. Now, when an enforcement action was carried out, the department alleged that the credit note results in a reversal of credit. When it was explained that the original credit itself was not taken, the question of reversal does not arise. The department was a bit myopic and the matters are still under discussions with them. And they are saying that if you not claim the invoice, that is your mistake. The time limit for that is over, but for the credit note, the reversal is required. Of course, this is an incorrect mechanism to look at the entire thing. And I'm sure we would be definitely able to close this matter in a, at some appropriate forum. But I'm just highlighting this so that it becomes clearer to all of us that till now we used to just net out these invoices and credit notes and just sleep over it. Maybe as time progresses, we also have to make sure if they are regular vendors to tell them that they do not make these types of mistakes and they don't mess around with our GSTR to be unnecessary. So that was just a small caveat which I thought would be relevant to bring about at this step. That takes us to step number 8, and this has been a very controversial step. It says that one of the conditions is that the tax which has been collected by the vendor from you should be actually paid by him to the government treasury. And we already had a section 16(2)(c) which laid down this type of a condition, and it was a subject matter of a debate because the trade always used to say that how do I ensure that the vendor has paid the tax? He pays a consolidated tax. He might pay in cash, he might pay by electronic credit ledger, and he will pay that tax for across hundreds and thousands of his customers. He doesn't pay individual tax for each transaction. And in that scenario, how do I ensure that he has correctly paid the tax? Courts have come to the relief of the taxpayer generally, saying that it is the onus of the department to establish the vendor has not paid the tax. It's also the onus of the department to chase the vendor first before they come to the taxpayer to reverse the input tax credit. Now, in the background of those decisions, this budget proposes a section 41. And that 41 section specifically says that whatever tax credits you have claimed, input tax credits you have claimed, if the vendor does not pay the tax, in that case, you are required to reverse the tax along with interest. There is a saving grace. We are told that if at a later point of time, the vendor ends up paying the tax, then you can reclaim the tax back. But friends, make no mistake, interest will be lost. You had originally claimed the credit because vendor did not pay the tax to the government. You reversed the tax, input tax credit along with interest. And later on, when the vendor actually ends up paying the tax to the government, you will reclaim the tax component, interest will be lost, and there is therefore a double whammy which happens because of this. A larger question is, when will this reversal get triggered? As of now, there is not enough guidance on this front. In our view, there is no voluntary requirement of reversal. It is as and when the officers or the GSTN portal educates you that the tax has not been paid. It is at that stage that you are going to go and reverse this credit along with interest. We had a very interesting scenario recently that the person had not paid the tax to and the basic amount to the vendor. The vendor did not pay tax to the government, and therefore the government came back to this person and said that look, under garnishee proceedings, you are required to pay to the vendor. Who will pay to me? Instead of that, you directly pay to me. And we are aware of these garnishing proceedings, wherein if there is something payable by you to a third person, your data can be attached. So that is the garnishing proceedings. Now the question which comes is, if I pay on behalf of the vendor to the government directly consequent to a garnishing proceeding, whether I can claim back that credit? Naturally, yes. It's deemed that you have paid to the vendor, and it's also deemed that the vendor has paid to the government, and therefore the right of reclaim gets ignited on the date when the you satisfy this garnishing proceedings. Practically, as we are aware, most of the organizations have started withholding or retaining the tax component until they see the tax in their books of accounts. To the extent that there's a retention, it's fine, but at some point of time, if that amount is written back in the books of accounts, please note that you cannot claim the input tax credit as well as not pay to the vendor, because then the doctrine of unjust enrichment will come into picture, and therefore one will have to be careful about making sure that you don't claim double benefit. Otherwise, there can be a contingent liability which can come up at some future point of time. So that's step 8. We now go to step 9, which is again a new concept brought in by this budget, and that's what complicates things drastically. We are now told that we had a concept of blocked credit, we had a concept of mismatched credit, we had a concept of unpaid credit. Now we have one more concept, which is a restricted credit, and this is now coming up under section 38 subsection 2, which is a new section proposed by this budget. Let's look at what does that section 38.2 say. Again, this is based on suspicion, and this is where one really doubts whether the whole objective of a seamless credit is there. This is a, make no mistake, this is a situation where you have received the goods or services, you have received the tax invoice, you have entered it in the books of accounts, it is not a blocked credit, and the vendor has uploaded it in your 2A, and maybe he has paid the tax also. But according to the government, they are suspecting that perhaps this is a fraudulent dealer, and that suspicion is based on some criteria. So those criteria they have tried to bring about in section 38.2. Though everywhere they have used the word prescribed, which means that the authority will now be with the CBIC to prescribe rules which will define this objective criteria. But what are the situations? The first situation is if you are receiving a supply from a person who has freshly obtained a registration, meaning he has obtained a registration and within 1 month he wants to pass on credit to you. Maybe that's what is being denied. Now, within 1 month is again an assumption or example. The law says within prescribed period, and that prescribed period is still to be defined. Same way, if that vendor has defaulted in payment of tax beyond a prescribed period, if his GSTR 1 output is greater than GSTR 3B output, greater by more than a prescribed limit. Now, as we are aware, ideally the total of 1 should come in 3B, but if in earlier months there were errors in 1 or in 3B, the rectifications of those errors may result in a situation where an output tax in GSTR 1 might be greater than 3B, which might be compensated by a deficit in an earlier month. In those types of scenarios, naturally, the government says that up to a prescribed limit, I will allow you to claim the credit. Otherwise, it becomes a restricted credit. And therefore, it's a scanner which comes in over here. Same way, if the credit availment in GSTR 3B by the vendor exceeds the unrestricted credit by a prescribed percentage, again, the objective is similar, that they want to track multiple chains that, there would be X who is a fake invoicer, and then you have Y then sells to Z and Z sells to A, and they try to regularize the chain. Now, the government through this type of a restricted credit provision is trying to attack not only the first interaction point, but the entire chain. Thereafter, we are told whose proportion of output tax discharged through credit exceeds the prescribed limit, and any other class of persons as may be prescribed. So essentially, while this section has been brought in, necessarily everything is kept open-ended because the prescription is still not out. So we of course, as and when the prescriptions do come in terms of the rules, we will again reach out to you, but this is something which you need to bear in mind, that this is something which is going to come maybe a few months down the line. We are still not very clear that if a credit is restricted in a particular month, Later on, when the matter gets resolved, will it go from restricted to unrestricted? And if yes, how? There is no detailed code available in section 38(2), which is proposed by the finance bill. So we will have to wait for the rules, and based on that, ideally there has to be a mechanism for reclassification from restricted to unrestricted when the vendor rectifies the defaults which have been mentioned from clauses 1 to 6. Only thing which I can tell you as of today is that I may not have answers for questions because the law has not given you answers, but I can definitely tell you that after the matching concept of 2B, which had a huge load on your systems and processes, the next step of additional compliance is going to come from the section 38. It's going to have a tremendous impact on your systems, because the systems will have to now not only gear themselves up to ensure that the credit is matched and paid, but also ensure that it is not restricted. And if it is restricted, keep a track of that restricted credits and take corrective action as and when required. Accounting will also have to have a separate class of credit as a GL code, where there will be a separate account, like we already had a deferred credit. This will also be something which will go in deferred, but we don't know up to what time this will stay deferred. And maybe even vendor interaction and business processes will need to undergo a change, because you definitely now vendor due diligence is going to be the key. Of course, in the past also we talked about it, but the emphasis on vendor due diligence and dealing with the right quality of vendors is going to be more and more important as time progresses. So that is step 9 brought in and added by this budget. Thereafter, we reach step 10, which talks about availment of credit within the prescribed timelines. We are all aware that section 16(4) requires you to claim input tax credit by the due date of filing the return for the month of September. This has been now proposed to be amended, and there has been an extension. We are told that we can now claim the credit up to 30th of November. While the law is amended to say that the credit can be claimed up to 30th November, the moot question which comes is, when is a credit availed? Because the outer timeline is for availment of credit. Is it when I pass entries in the books of accounts? Is it the period for which the credit is claimed in the returns? Or is it the actual date of filing the return? Let me give you an example. If an invoice for financial year 22, and assuming that this law becomes effective on is effective for financial year 22. In that scenario, assuming that there's an invoice of 22 and you have accounted it in your books of accounts on 30th November, but you show it in your GST returns in December, whether it will be allowed. In my view, no, it's going to be a very complicated game, because effectively, if one interprets that accounting in books of accounts is the availment, there is a possible view of that nature, but we do not subscribe to that view. It could result in a lot of difficulty and a misuse of the provisions. But then when should it be the last time when I claim the credit? If it is 30th November, does it mean that the return for November, the 3B for November, which will be filed on 20th December, is it okay if I claim in that? Or does it mean that the 3B should be filed before 30th November? I would believe that the 3B should be filed before 30th November. So effectively, for the October cycle of 3B, which will be filed on 20th November, that would be the date which would be the cutoff date for the timeline for claiming the input tax credit. I am aware that between the second and the third bullet points, there could be an equally strong view in either of those two matters. That takes me to the next step. You also not only need to avail the credit within the prescribed timelines, you also need to file the return within the prescribed timelines. Again, this will become relevant only if it is held that the availment of credit happens when the return is filed. If we are going to interpret that the credit is availed in the period of the return, then this may not be really that relevant only from the perspective of an input tax credit. But friends, please note that this step again has importance in terms of interest. And as we know that interest, when we are calculating the interest is calculated not from the date you make a payment, because the payment happens through a PMT challan and it goes and hits your electronic cash ledger. There is a proviso to section 50, which says that for your normal returns, you will pay interest only on the cash component utilized. But if you are utilizing that cash component late, we might face a challenge of an exposure of interest even though the tax is already paid and appearing in your cash ledger, if you have not utilized it, there could be an interest exposure there. So that is one point, which also makes you more disciplined in making sure that you file the return within your prescribed timelines. That takes us to step 12, which talks about payment of amount and tax to the vendor within 180 days. This is a transaction between you and your vendor. And as we are aware, the second proviso to section 16.2 requires you to reverse the credit if you do not pay or rather fail to pay to the vendor within 180 days. And this interpretation of fails to pay becomes very important. We in earlier sessions we have talked about it. There's a difference between does not pay and fails to pay. Fails to pay is more active act on my part, which implies that if there is a contract which requires me to pay only after 8 months or 9 months, then there is no active failure to pay. So retention monies or scenarios where there is no failure to pay, only a payment remains outstanding, that will not get covered by this. It's only where there is a failure to pay that there will be a reversal. The concept of payment includes book adjustment. We have a rule which specifically says that for branch transfers, there is no requirement of notionally paying to your branches. We are aware that the proviso requires you to reverse the credit along with interest. Again, like I highlighted in rule 42, here the interest would be applicable irrespective of the amount of credit lying in your electronic credit ledger. Again, when you pay to the vendor, you are allowed a reclaim of reversed credit. Again, interest becomes a cost. So to some extent, the provisions here are similar to the ones which we discussed a little bit earlier. So we've completed 12 steps. We have still not completed our conclusion on the eligibility for input tax credit. And quite a few of these steps, of course, were dependent on me. Some of these steps were dependent on the vendor. But now we have some really uncertain payers. And that's where step number 13 comes into place. After you claim the credit, you filed the return, you paid the vendor, you can't be rest assured and have a sleep that the credit is indefeasible, as the Supreme Court used to say 3 decades ago. There is always a risk of a retrospective cancellation of the vendor's registration. And we have seen those types of notices coming for past periods, and based on those experiences, we've tried to incorporate this step 13. And that step 13 is that every day you should pray to the God that the vendor's registration is not retrospectively cancelled. Section 29 subsection 2 does provide for such type of a retrospective cancellation. And we've seen situations where registrations do get cancelled here. And if they do get cancelled here, then based on some parameter number, the state tax officers issue notices under ASMT 10 demanding a reversal of the input tax credit. Just to rebrush, section 29 subsection 2 talks of various circumstances where the officer can retrospectively cancel the vendor's registration. Where the first one you can see as a circumstance is a very open-ended one, which says that the vendor contravenes with any of the provisions of the law. Second, he is not furnished returns if he is a composition dealer for 3 months, for others it's 6 months. Of course, this 6 months is proposed to be changed by the finance bill. Again, the CBIC wants to take a power to prescribe the number of consecutive months, the non-furnishing of which will attract a retrospective cancellation. The third one is interesting. It says that if you not commenced business within 6 months after taking voluntary registration, the number can be retrospectively cancelled, or if the registration is obtained by fraud. Now, make no mistake, in all these cases, the vendor might have raised invoices on you, supplied you goods, uploaded the taxes, paid the taxes, and would have filed his returns also. So, to safeguard yourself, to explain your bona fide, we strongly recommend that at a periodic level, you should take a screenshot of the return filing status of the vendor to make sure that, to explain that, yes, at that relevant point of time, his registration was valid and a retrospective cancellation cannot result in a prejudice to you. And this is what was held by a high court in the LGW Industries case, a recent decision wherein a similar position was held by the high court. So this is the step 30. Step 14 is again a prayer. You have to keep on praying that any of the GST audit teams from the government or any of the agencies, anti-evasion, DGGI, all your jurisdictional authorities, do not try to deny your valid input tax credit on flimsy grounds. Again, this is not based on law, but these are some experiences which we have faced, and we are just sensitizing our clients that these are things which are happening at a ground level. In one of the states, what we found was that the officers obtained the details of the HSN uploaded by the suppliers. And they assumed that if the HSN is 21, it is relating to food, which is a part of section 17.5 disallowance. And based on that, a notice was issued for disallowing all credits where the HSN uploaded by the vendor was some characters which related to motor cars, related to food and beverages, or list items which are under the block credit list. While issuing these notices, the department had no visibility on whether the taxpayer has claimed those credits or not. And our experience was that in most of the examples like this, the taxpayer himself had not claimed the credit because they were ineligible. But despite that, all these types of notices in ASMT 10 have been received and have to be responded within the timelines. GSTR 2A 3B mismatch, GSTR 9 table 8 mismatch, inward e-way bills of goods less than the input tax credit, not even considering the fact that ITC is for goods as well as services, whereas inward e-way bill will be only for goods, and that too for high value goods. Despite that, a parameter based notices have been issued in some cases. ICE gate mismatch, even though the law does not at any point of time require matching of ICE gate transactions, customs transactions, yes. Despite that, we are finding ICE gate mismatch coming up as a parameter. And the last one is a tricky parameter, wherein we saw section 16.4, which says that you have to claim the credit within a particular timeline. But this parameter suggests that it's not only that you should claim the credit within the timeline, but it should also be that the supplier should file the returns within that timeline. Now, of course, the law does not prescribe that type of a requirement, but despite that, we are seeing notices coming on all of this. Typically, all of this starts as an ASMT 10 notice, which comes from a GST portal mismatch and GST portal data, which also many times does not have detailed supporting. Based on responses which are given, the next step after ASMT 10 is the issuance of a show cause or a pre-show cause notice in DRC 1A. And to say the least, most of the cases we find that while issuing DRC 1A, the officer merely writes a one-liner saying that either no response has been submitted or documents have not been submitted, or at the most he'll say explanation is not found satisfactory. Even though you might have given a 10-pager explanation to that entire thing, just one line in the DRC 1A, either not acknowledging any response, or even if they acknowledge, they just say explanation is not found satisfactory in a one-liner. And this is how the seamless credit really becomes less and less credit rather than seamless credit. So that is one area which we will have to go through these pains, and at some point of time, I'm sure sanity will prevail and better sense will prevail on this. That takes me to the 15th step. We are closing towards the 18 steps. We are now on the 15th step, wherein the credit which has been claimed should be utilized for payment of output tax. And section 49.4 clearly says that you will use it for self-assessed output tax in the GSTR 3B. You can't use it for paying the tax payable on RCM because it's an input. Input cannot be used against an input. So even if you have substantial input credit lying in your ECR, the RCM payable will have to be paid in cash. All of us are aware of this and we are implementing it in a reasonably nice manner. But then there are three questions which come up. And these questions are tricky questions. And the first question is whether I filed returns regularly, but at the time of filing annual return in GSTR 99C, I find that there is some tax which was missed out. And I want to pay that tax, whether that dues as per annual return can be paid from an ECR balance, the credit balance. The law does not have a very specific prohibition on that, but there was a circular or a press release issued by the government to say that it cannot be used. So therefore, this is going to be a bit tricky. According to us, the credits can be used. The DRC 3, which is typically used for paying this dues as per annual return, does permit you to utilize input tax credit from the ECR balance. And in practical scenarios, we have been doing it. When we are aware that the legacy service tax law has various litigations and orders are now coming. Most of them not coming favorable. If they don't come favorable, you have to file an appeal. And the appeal under the earlier law requires you to pay a mandatory pre-deposit of 7.5%. Only challenge which comes up is that the entire mechanism for collection of service tax has been dismantled. And therefore, you are unable to pay service tax through a service tax challan with any of the bankers. And therefore, the CBEC issued a circular saying that the pre-deposit of service tax can be made from the GST balances from the electronic credit ledger. And similar view was also taken by Dell International in the tribunals, in one of the tribunals case. Despite that, we are seeing, especially in one or two cases, the commissioner appeals not accepting a payment from ECR and rejecting appeals on this ground. So this is again one pain area which comes in. The next logical question is whether pre-deposit of GST can be paid from an electronic credit balance. I would believe so. Definitely it can be paid. But I need to highlight to you that there is an adverse decision from Orissa High Court, which says that the pre-deposit of GST cannot be paid from the credit balance and has to be mandatorily paid in cash. Matters will have to be litigated on this front as time progresses. So that is step 15, utilization of input tax credit. Now, after utilization, you might still have accumulation. And if you have accumulation, step 16 would suggest that you file a refund application for such accumulated input tax credit. Section 54 permits you to do that if that accumulation is on account of making zero rated supplies, maybe supplies to an SEZ unit or a developer, or an exports of goods or services. Make no mistake, the refund is available only if the accumulation is of inputs and input services. Accumulation on account of capital goods is not refunded back to you. As far as inverted rate structure is concerned, we are given refunds of only accumulation on account of inputs. Even input service and capital goods are not allowed. On the input service front, there was a huge litigation with contradictory high court decisions. Matter went to the Supreme Court, and Supreme Court has settled it to say that it's only inputs which will be eligible for a refund in case of inverted rate structure. There was, of course, the refund application has to be filed within 2 years from the relevant date. And in case of SEZ units and developers, there was an interpretation issue on the relevant date, how to calculate that relevant date. And to answer that situation, the Finance Bill 22 has given a provision, has made a provision to say that the relevant date will be the date of the return in which the supplies need to be disclosed. Naturally, for these two situations, you will claim a refund of accumulated input tax credit. Otherwise, if there is a balance of input tax credit and you close your business, or you are transferring your business either by way of a merger, amalgamation, or a slump sale, then you can file an ITC-02 and transfer this closing balance to the new entity who is going to continue the business. But the question which comes up is what happens on closure of business? And honestly, Section 54 is deficient. It does not address this situation. Like the old rules, Senvet credit rules also did not address this situation. And in the Senvet credit rules, when there was no specific provision either permitting or denying these types of refunds, a matter in the case of Slovak India went all the way to Supreme Court. And the Supreme Court said that while there is no express provision to give you a refund, there is no express provision denying a refund. And therefore, if you have closed the business, then the amount which was ideally due to you should be given back to you. So Slovak India was a favorable decision. In a later Bombay High Court decision of Warwick Plasticulture, this has been challenged and there is a doubt cast on it. And in GST, of course, the law is slightly different. So we will have to wait and see how this spans out in the future. That's taking us to the next step, that if you have accumulated input tax credit and balance lying, you can carry forward accumulated input tax credits. Nothing great to talk about it. It's just a closing balance of one period, which becomes an opening balance of the other period. But when you have these balances which continue for a reasonably long period of time, you need to worry about the step 18, which is blockage of electronic credit ledger balance. And this is a provision where we saw the cart before the horse. And we had, and that's very common in the GST, we had last year a couple of rules coming in, Rule 86A and Rule 86B. And we have discussed that earlier. 86A permits a commissioner to block the utilization of a balance in your electronic credit ledger based on certain suspicious transactions. Of course, there was a provision which says, that the blocking will be for a maximum period of 1 year. We've seen live situations where the blockage is for a period fundamentally beyond that 1 year period. And in that case, people have to go to the courts. When they go to the courts, they not only challenge this act of, illegal act of blocking beyond 1 year, but at times also the virus of Rule 86A is being challenged to say that the rule does not have any backing on the basis of which it has been prepared or created. The legislature has not authorized blockage of credits. And that's where this finance bill, we have section 49 subsection 4, which enables the introduction of rule 86A, which has come in this budget. Similarly, rule 86B was prescribed to have restrictions on utilization beyond 99% through ITC. So if you have an output tax of 1 crore rupees and you might have input tax credit of 1.5 crores, you are told you can't utilize the entire 1 crore. You have to pay minimum 1% in cash. You can't utilize ITC beyond 99%. Now, while this was a provision, there were lots of exceptions which were laid under Rule 86B, which are there even today. One of the prominent ones being that you have paid certain amounts of taxes over the last 2 years, or you have claimed a refund or things like that. And therefore, the applicability of Rule 86B is very limited. Again, constitutional challenge of whether you can have an 86B without a section, and that's why you have now a section 49 subsection 12. So long as we read 49.4 and 49.12 as only to operationalize rules 86A and 86B, no issues, that's not a big problem. But moving forward, if rule 86A and B get diluted and the scope gets expanded, then maybe some of us may face a lot of difficulties on this front, and therefore we need to be a little bit careful about this aspect. So friends, that summarizes the 18-step process of claiming input tax credit, and each credit, as I was highlighting, will have to pass through this scanner of 18 steps before you can really go ahead and say that the credit is seamless. This covers a chunk of the amendments of the budget, but just to summarize and round it up, we have a last slide wherein we'll be talking about the other amendments in the budget relating to GST. As we have talked about, right, there is a course correction in the return filing process. There will no longer be a two-way communication, which never got implemented, honestly, between the supplier and the recipient. So the process now is very simple. Every month, the supplier will file a GSTR1, which is a statement of outward supplies. He is required to file it by 11th of the next month. It's important that he files it by 11th, because if he does not file it by 11th, and let's say he files it by 12th, in that case, the credit will not get reflected in the customer's to-be of that month. The credit to the customer will get delayed by 1 month in that scenario. Therefore, there is an indirect policing which has already come in, that it's important for everyone to file a true and correct GSTR1 by the 11th of the next month. Otherwise, in business, that person will face challenges from his customers and queries from the customers. Once the GSTR1 is filed by the 11th by the supplier, it comes in the GSTR2B. I understand it comes by the 13th or the 14th. And thereafter starts the process of matching of credits. As talked about, there's a detailed slide where detailed presentation which you can go through. You have to do the matching and accordingly claim the credit in GSTR3B, pay the taxes as applicable in GSTR3B, which has to be filed by the 20th. And thereafter, at the end of the year, you have a GSTR9. And if your turnover is above 5 crores, you also have to file a GSTR9C. So this is the settled proposition now, which has been now synchronized between the Act, the rules, and the portal. While all of this is being done, to ensure better compliance by the suppliers, we are also told that the return process, which was mentioned above, will be sequentially followed. We are told that a GSTR1 for a month cannot be filed if the previous GSTR1s are pending. You can't file a 3B if the previous GSTR1 or a previous GSTR3B is pending. And therefore, by making sure that there's a sequential filing of returns, we are ensuring a better discipline in this entire system. Having talked about all of this, just a couple of beneficial provisions. We talked about the extension of the due date time limit for certain for claim of input tax credit from the due date of September to 30th November. We talked about it in one of the steps for input tax credit. Similar extension of timeline is available for B2B amendments in GSTR1, disclosure of issuance and disclosure of credit notes in GSTR1, GSTR3B related amendments, and amendments of TCS particulars if you are filing a TCS return. So in all those cases, now the cutoff will be 30th of November rather than the due date of September return. We are now permitted to transfer excess electronic cash ledger balance from one GSTN to another of the same PAN entity. We talked about interest liable only on wrong availment as well as utilization of credit. And we talked about the fact that the relevant date is been defined for SEZ refund applications. A couple of retrospective exemptions have been given from July 17 to September 19. for transactions of supplies of fish meal, and also in case of alcoholic liquor, where license fees for obtaining a liquor license were to be paid under reverse charge mechanism. There's a retrospective exemption which has been given. So these are some of the beneficial provisions which have been brought in the budget. And with that positive note, I would like to end my discussion and thank you all of you for a very patient hearing and attending in large numbers. If there are questions, maybe we can take a couple of questions and then take it forward from there. I think Ramakrishna has a query. Is construction to a government authority, is there any amendment? Well, there was an amendment in January and we did discuss it over there, that there was a substitution of the notification which granted a concessional tax rate, and you might refer to that provision and then accordingly take it up. Ankit's query is, what will happen if post re-availment total ITC in GSTR 3B exceeds the GSTR 2B amount? Yes, this is going to happen because in 3B there are no separate columns to mention the recredits and other things, and therefore you will have a credit in 3B which will be greater than 2B. Of course, we are planning to send representations to say that the GSTR 3B should be amended and maybe a couple of more rows should be introduced in 3B, so that you have one which talks about the matched amounts as per 2B, and then recredits and other adjustments come up separately. If that happens, I think life will be simpler. If that doesn't happen, then every couple of months we will get notices from the department and we will have to respond to those notices and pray that the officers understand what we are trying to say or they intend to understand. So that is a challenge which does come in. I think with that we have winded up the questions. Thank you once again for a very patient hearing. We will log off. This entire session is available on YouTube as well. And the past sessions are also available on YouTube. Of late, we are making sure that every month we diligently send a newsletter on the WhatsApp as well as the email list. I'm sure you are receiving them and you are going through them. If there are any suggestions, we will be glad to hear from you by email or by telephone whenever it's convenient to you. Thank you very much. We would now